Welcome, 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 everyone. We are so thrilled and happy to have Gary Payroll with us. Gary's life has changed so much over the last couple of years in many, many ways. And yet he has been working with notes for some times. And today, if you know what a note is usually a trust deed, which is secured by the property, real estate property. It could be a single family, it could be commercial, it could be anything. And he is going to talk about partials, which most people never talk about. So I think that'll be fun. So partials are, I'm going to let Gary tell you about that. Gary and I've known each other for, I don't know, Gary, what, 10 years?
About that, yeah,
Yeah, we met at a real estate lunch meeting and
that's right.
we've just been hanging out together, doing all kinds of things, mastermind groups and
Sharing
networking
deals.
and sharing deals and supporting each other. So today I would like to present to all of you, Gary Payroll.
Well,
Take it away,
thank you.
Gary.
Thank you all. I've got you on my headset because my grandson is in the room next door trying to take a nap. And so I'm in Las Vegas. I'm lifelong Angelino. I was born and raised in Los Angeles. I was actually born in the streets of LA, not the streets of San Francisco like the old TV show with Carl Malden, but that my parents couldn't. I was newborn, preemie, and my parents had never been to the hospital because it wasn't time for me to be there yet. And all of a sudden, it was time. So they didn't know how to get there, and they ended up getting lost several times. And I ended up being born in the car on a street corner. And my dad ran into a drugstore and screamed for a doctor, and a little Japanese lady came out and said, "I'm a nurse." And she went out to the car, and I was a rarity. I was born with the bag of waters, the amniotic sac, still unbroken. I came out in a bag of water, and they were going to leave me in there until they got to the hospital. Say, "Good, he's shrink wrapped," and of course I would have drowned. So the nurse knew this. She ripped it open, saved my life, unwrapped the umbilical cord around my neck. It was wrapped around there 3 times. So that's probably why I was born early. Other people would say that explains a lot about how how I work. But anyway, yeah, born and raised in LA. And now I am in Redding, California, which is in Northern California. Been here for about a month. So that's only one of the changes that to which my friend Peggy was alluding. But with that, I would like to talk a little bit about notes. I have a presentation to go through, but what is a note? A note is a promise to pay. And that normally in our world is secured by a trust deed. Sometimes it's secured by a contract for deed. The primary difference being, do I get the deed at the beginning of the purchase, when I start making payments, or do I get the deed at the end of the purchase? Not a big deal to most note investors. The contract for deeds are kind of becoming passé as courts decide that somebody gets equity and you can't just boot them just because they don't have a deed yet. So the benefit to the lender, the guy who's holding the property and is selling it with seller financing, that benefit of a contract for deed is diminishing. So most people just go with a trust deed or a mortgage, and that's the typical way. If any of you bought a house, depending upon the state, you've used a trust deed or a mortgage to get a loan from a bank. But again, the note is for the loan. The mortgage or a trust deed, that's the security instrument that ties that loan to the property, so that if the borrower stops paying, the bank has an option, or the lender has an option. So with that, I'm going to go ahead and share my screen and talk about where most of my notes come from. So most of my notes are brought in from seller financing. And seller financing, people sometimes wonder what that means, because in a seller finance deal, the lender doesn't actually give money to somebody, but they're assigning debt. And if you think about a three-way transaction, where you're buying, somebody's selling, and then the bank is lending money, what you do basically is you take the bank and the seller and merge those into one thing. And so now there's still a debt that's owed, but instead of being owed to a third party over here, you owe it to the person. Kind of like, you you pay me a down payment, and then you keep making me payments over time. Those payments could be just broken down into equal monthly payments, interest fee, principal only. But investors like to make interest, and so we loan money when we sell properties. And this statistic, 1 in every 50, is actually a little old. That was an 800% increase. That's from last year, so it's probably even higher now. But in 2021, I looked this up, and 23.6 billion in seller financed real estate loans were made in that year. And so it's still a small fraction, but for people like us, it's a very substantial fraction. And honestly, if you don't want to go after the 98%, you want to have a niche. You don't want to be playing against the big boys. Although there are some fairly big players in the seller financing arena, and we'll talk a little bit about that as we go through this. So now you can raise your hand and ask questions as you go. I'm hoping for good Q&A, but Peggy, if you could stop me, and if somebody raises their hand, I probably won't be able to see it. If I do, I'll stop, but if you want to stop me, feel free. So where can someone buy notes? You can go from the banks, the lenders, the people actually making the loans. You can go to people who are buying large numbers of loans, because there are institutions that buy loans from Fannie Mae, Freddie Mac, and from Wells Fargo directly, from credit unions, and they have large pools of notes, and they send these notes out on what are called tapes. They're basically Excel spreadsheets, and then you can buy them off of the list. You can buy them from individual note investors like myself. You can buy them from private note originators. Those are probably investors who are buying usually low-end properties, rental type properties, and then instead of creating cash flow by renting them and maintaining them and owning the property, they actually sell the property with a note, and that's a promise to pay. Kind of like what a tenant would do. Tenant promises to pay based upon a lease. A buyer with seller financing has a note, and he promises with that note to make payments, and that's something that private note originators, investors who sell properties, they're flipping properties, but instead of selling them retail for cash, they're selling them for a down payment, and they're taking payments over time. And there are some, and a substantial number of people who just create a note just for the sake of a single transaction. They're really not in the business. They just are stuck in a situation where they can't sell a house. Somebody says, I've got $40,000. What can we do? And so they work out an arrangement. Those notes are usually not very sound. There are lots of problems generally with those kinds of notes. So you generally have to pay a significant discount, or going to want to pay a significant discount if you're buying a note from a single mom and pop seller. So any questions at this point? I'll just pause right here and see if anybody wants to unmute your phone and ask a question.
Yeah, we usually like you to do like a 20-minute presentation, and then we go to Q&A. Does that work?
Want to do that? That'll work. That's fine. I can just
I'm
blast
writing
through
the
this.
questions down as we go.
Oh, great. Okay. So we started about 10 after? Or a little sooner than that?
Yes.
Okay. All right. So when you buy a note, there are two different ways you can do it. You can do a full purchase, or you can just buy a portion of the note. That's called a partial. And Peggy had said that she had other people on her show in the past talking about selling notes, buying notes, but nobody really talked about partials. And this is a really great way to create income for yourself using an aspect that not everybody knows about. And the first option we'll talk about is the full purchase. That's where basically if you had a $100,000 note, 10% interest, 20-year term, you basically, and you've collected a certain number of payments, the buyer is buying all of those payments for the entire note's being sold. So that would mean that if I have this note and I sell the entire note, I no longer have any interest in it. We set up the allonge or the transfer, of all this stuff to you, to the buyer, and I no longer have anything to do with that note. And I just get a lump sum, and all future payments are going to the new note holder. Now, notes are typically bought at a discount. So if you have a $100,000 note, if it depends on the quality of the note, and the quality of the asset and the interest rate and all sorts of things. But typically, you're not going to buy a note for the full value. So if the unpaid balance was $100,000, as a note investor, I would want to pay less than that so I can make my money. You make your money when you buy. And that way, if the borrower came around and refinanced immediately, I still make a profit. As a matter of fact, I'd make a nice profit. In this case, I'd make $15,000 in a very short order. Or I can hold the note and collect that profit over time. So that would be the 15% discount. Now, a partial purchase is something different. That's where the note owner sells some of the remaining payments. So in this case, if you have a $100,000 note, 10% interest, 20-year term, okay, the portion that could be sold might be only 120 months instead of the full. And that would mean that you, as the partial note buyer, would collect payments, and you would essentially own the note for 120 months, but you would be contractually obligated to transfer the note ownership back to me after you had collected your 120 months of payments, and then the end would revert to me. Now, you get the front end of the payments, so that works out to be a great deal for you because the time value of money means you don't have to wait as long for your payments, so that's worth more to you. And then I'm on the back end, but if I'm trying to set up something for my kids, or for a younger person, if you were setting up for retirement in 20 years or 10 years, this would be a great thing. And for me, 10 years, I'm still hoping to be, vital and healthy and running around and have lots of traveling to do. So this could work out for me as well. But this is a situation where you're buying only a portion of the note. And that would be retained, and then the back end of the note would be retained by the seller. So this is what it looks like if you looked at that, and in this case where you would only have to come up with probably $62,000, $63,000 for the first half of those payments, and then the rest of it would come out here at the halfway point. Your payments would end, and then my payments would start, and then I would continue to get paid. And if I held that to the end, I would get all of my money out that way. And if anywhere along the ownership axis, if the borrower refinances, then you as the partial lender, like say 60, this is 60, so this is around the 5-year period, 60 months. You can see if you come up here, if they paid off at that point, you had paid $62,000, $63,000. You're still making $47,000 lump sum if they refinanced after 5 years, and then the person who owns the rest of it would get what the remaining balance. So the benefits, and this okay. So I forgot that the numbers were already there. So the benefits of buying a partial are shared risk. The seller of the partial, let's say me in this case, still has a vested interest in securing the note. So if something happened and the borrower stopped paying, you as the partial note buyer would not have to be solely responsible. And since I'm closer to the origination of the note than you are, and presumably I have more experience, the odds are that I'm going to be more involved in that workout situation than you would be. And in fact, you can even as a buyer, it would be wise for you to specify that in the sales contract, some sort of arrangement, stipulation as to what happens if there's a default. there's not only is there a good lower risk because you're sharing the risk with the seller, you also have lower inherent risk to a partial buyer. And why is that? Because you're only purchasing a portion of the note, so your investment to value is lower. This allows for people who buy newly originated notes, they usually buy a partial because they don't want to, there's no payment history, and their loan to value is investment to value is fairly high, that they're investing, they would have to invest a lot of money relative to the value of the house in order to make that work, and that increases the risk. The third benefit is that it's easier to deploy capital. When a partial note is paid off, you have to reinvest, but in this case, you don't have to go out and underwrite another asset. This is an asset that's already been paying you off. And so if you like the asset, you like the interest rate, you can just roll it over and do it again, and it just makes your life easier. So those are the three benefits in coming in and buying a partial. The primary one being one of risk, but the other one is just having a relationship with someone who now has been provided you with a cash flowing asset, and it's very simple to just roll that over again and buy the second half of that note, or if you break it into three, to buy the next portion of it. So with that, there's a lot more that we can talk about, Peggy, and about partials, and I'd be happy to take any questions that people might have.
Well, my bet is Cliff's going to have a lot of questions on this. So
Excellent.
thank you, Gary. That was a great presentation.
Excellent.
I would
My
like
pleasure.
you to, if you don't mind, on that last
Oh.
slide.
Yeah. Sorry.
You had said something about something being simpler or easier, or the deploy of the capital on the, do you have that last slide?
Yeah. Just right here. And that was if somebody.
You're saying it's easier to deploy capital. So what you're saying is once you get the money back, you just go out and
if somebody, okay, basically let's go to here. If somebody likes the first 120 months, the second 120 months are just like the first 120 months. And so what I'm saying is you've already completely vetted this asset. This asset has been paying you for 10 years. And if you like it, you can just continue. You can just make a bid to the seller to buy the next portion of the note. And if you want, you can even just negotiate on the price. I mean, at that point, after I had been set, because see, here's the neat thing on buying a partial is that I haven't been getting that money every month. You have. And I'm not dependent upon that money coming in. Okay. So if you came to me and said, "Hey, Gary, remember when you sold me that partial 10 years ago?" I might want to be willing to buy, the rest of that note. I'm not dependent upon that. I'm not emotionally attached to it. So it's easier for me to sell that because I'm not in love with that check coming every month. And the idea of getting a lump of money is now pretty attractive to me, especially, and so that gives you a lot of negotiating, because I'm more likely to take a lower price for the second half of that note than I would have been if you'd have tried to get me to discount the whole note.
Great, thank you. Got it. Very much. And Kathy Scalzo has a question.
Hi, Kathy.
And
What's
could
your
you
question?
stop sharing?
Kathy, do you have a question, and do you want to unmute your line?
It's actually a friend of Kathy's. That's why it still has her
Didn't
name
look like
up there.
Kathy, but I can't
Yeah.
tell.
I know, it didn't look like Kathy.
Gary, could you stop sharing the screen, please?
I can do that.
So
I
who's,
was going to say, I'm sorry, she sent me the link. My name is Sally Gimmon. Gary, where did you get your tapes? I used to do delinquent notes.
Yes.
That my mentor used to get the tapes from different places. Where do you get your tapes?
I don't generally buy tapes. When I do, I don't like bidding against everybody else. So my niche is seller finance notes, and I actually go directly to the originators.
Okay.
So when somebody will send me something, but you can go to, as a matter of fact, let me put my I'll change my name here. I'll put my my email here. The easiest email is just my name, my first name dot my last name at Gmail. That's not my business, but since I've got Gary Payrow there, it's already there. So if you want to send me information, I can send you a list. And but there are. I am just having a senior moment here, trying to think of the name of the couple of institutions that sell this. One is one place you can go though is PaperSource. So PaperSource has come on fairly recently, and they're an excellent source for notes. So everybody should write that down. Papersource.com. They don't send out tapes, but it's a marketplace for notes, and you can find some excellent deals there. I have kicked myself when I've seen some of the deals that come off there. So I meant, note to self, I should spend probably 3 days a week going in there and seeing what's available. So PaperSource is good.
Who's others? I can't remember his last name. George out of Chicago. He's got a note place too, but I haven't
Okay,
found
and
very
then
good deals there.
FINRA. What I can't remember what FINRA, FNRA, I think it is a good one. And then Note School is one where I purchase notes. That's Eddie Speed's company. They're they don't leave quite as much. They're more consistent. They don't leave as much meat on the bone as some other places. But they're a high quality place. They've vetted their stuff, and you can also go there. And let's see, it's not Note School. What is it? It's Note.
And there's lots of others. There's Cindy Cole that has a note. She would sell parts of hers.
Right.
There's and I can't remember the guy that's down in Orange County, California, that's always got lists, but he leaves nothing on the bone as far as I'm concerned.
Yeah, unfortunately-
Even in some of your RIAs.
Notes Direct. I'm sorry, Kathy. Wait, what was your name? It's not Kathy. It's
Sally.
Sally.
Sally. Notes Direct is not. It's not Note School. It's Notes Direct. That's associated with Note School.
If
Well,
you
then one
want to
thing
buy
the one-
partial ones, Sally, if you want to buy partial notes, all your local RIAs, there are people who are selling them all day long. I see them all the time. I refuse to understand them because I have enough to understand. But in my Zoom meetings and stuff, there are people who have already bought them and a lot of them guard their sources. Really,
Yeah, they do. So
Close
here's another place, and nobody ever thinks of it. Call the escrow company and tell them if a seller doesn't want to carry back a note, you will do that. And then you could set the terms right at the beginning.
That's a great idea, Peggy.
Yeah, I was going to start that as a business, but I'm doing this. It's a lot more fun.
I was going to say get skinny. Unfortunately, during COVID, what we had found was so much money went into notes that you weren't getting as great rate of return. I mean, I'm picky. I don't pay anything more than 70 cents on the dollar. If some of the notes want 90 cents on the dollar, that's just too high.
Of course it is. 70 cents is too high also.
I got one note
My
for 64 cents, but yeah, that's what we're trying to do. Thank you.
There's so many people in the business now that are doing that. We didn't ever pay more than 30 or 40 cents on the dollar when we were buying notes. But as you
Performing
say,
or non-performing, Peggy?
usually they were performing, they were fresh. They were take them not what is it when it's been there for 3 or 6 months?
Seasoned.
Non-seasoned notes.
Right.
Take them straight
Duly
out of
originated.
escrow.
Okay.
Like that. Yes, Clip, I knew your hand would be up.
Yeah, I was
Yes,
waiting for
Cliff.
everybody to kind of get their questions in. So first, the website that you sent us, papersource.com, that actually sends us to a stationary site. So we might want to try and figure out what that one is.
Papers. Okay, thank you.
And then I do have a handful of questions here. So when you're actually creating a note, what's the best rule of thumb for assigning an interest rate to that note?
Okay.
Because I
It's-
know that if it's too low, then it's not really going to be appealing to a buyer.
Yeah. Okay, I'm sorry. It's paperstack, stac.com, not stack. So thanks for checking me on that, Cliff.
Sure.
Paperstack.com with a C, not a CK. And really, it's just it depends on who's buying. If they're note buyers, you know, it's got. Oh, actually, I should ask: are you talking about when you're setting the original interest rate on originating a note?
Correct. Yeah. When you're
okay,
originating
okay.
a note, how do you
Great.
know what rate to put on there? Because
Great.
you know, I've heard a lot of investors, they won't even entertain looking at a note if the rate's too low.
Okay, that's true. Although there are ways that you can buy it, and buying a partial is one of those ways.
Okay.
So there are things that you can do. Also buying with a discount, okay? Because when you buy with a discount, even if your rate's not great, most borrowers aren't going to hold that loan more than 7 years. And so if you really like the asset and you're getting a screaming discount on a note, even if it was written at 4%, that may be okay. You know, if you're not tied to the cash flow, if you don't have to have the cash coming in every month, and you really love the asset, you know, I've seen very seasoned note investors buy, with marginal, what I would consider a marginal rate, just because of the discount that they have and they love the asset. But let me just back up and just say, Cliff is asking an excellent question, and the scenario is you're selling a property, you're taking a down payment, you're going to write the terms of the note. What should you make that? And one question is the borrower or the buyer a homeowner? Is it going to be owner occupied, or is it going to be an investor? Cliff?
Let's say it's going to be owner occupied.
Okay, owner occupied, then you have to take into account the SAFE Act and Dodd-Frank. And so I'm not an expert, but my understanding is that, so I'm not handing out legal advice, but my understanding is that you need to keep it within a certain range of the lending prime lending rate at the time, and generally under 10% for a owner occupied. So that's so most investors want that to be fairly close to double digits. So a lot of people will say somewhere between 9 and 10% is a good number to be at. If it's an investment property, you can go above that. Then you're worried about the usury laws in that state, so you have to be careful with that. That's where you could get in trouble if you go too high. But again, it's usually about the monthly payments and the value that you bring. So the best way to do it is to put yourself in the shoes of the borrower and say, what's their situation? Why would they go to a bank? Is it because this property is not bankable? Is it because they're not bankable? They had a bankruptcy, or they're self-employed and their income's up and down. You have to do your underwriting, and if you can keep it between 9 and 10%, that's good. If you can do it, your business model works for less, and you want to help people buy affordable housing, that's great. But it's you have to keep in mind that a note buyer, you want to be able to create a note that somebody else is going to want to buy, even if you maximize your exit strategies. So if you needed to sell this whole note, how much would you have to discount it in order to sell it? And part of that is the rent, the market rent. So if your monthly payment is out of line with whatever the market rent would be for that property, that's not a good scenario. So look at the market rents, adjust your note. The values on a note are how long do they have to pay, what's the interest rate, what's the amount they're borrowing, and did I forget something there? Interest rate, the term, and the amount. So you can adjust the term of the loan if you want to make the payment lower, but you want to keep that payment fairly close and actually a little bit below what the market rent is. So if that guy ever decided he was having trouble making the payments, is, if I want to rent a similar place, I got to pay this even more in rent. That's a very good strategy for someone who's looking to buy a note. So you want to keep it adjusted. So between 9 and 10%, adjust your payments relative to the market rent, and that's what I would say.
Okay, that makes sense. And where would you find a good example of what a good, well-written note looks like?
Well, I have I'm a Note School member. That's good. Robert Orfino, Peggy's, and my friend has done classes on that. But the best way to do it is just to Google. Go to Google and say, what are the terms of what's essential for a well-written note, and you'll find lots of information on that.
Okay. And would a partial note be discounted? And if it is, why and how much? And is it different on the first half or the second half?
Well, the second half, you wouldn't sell it the second half typically.
Okay.
So if any of you have the HP 10B calculator, I mean, I'm just going to flash a quick version of it, from my phone. That's kind of what it looks like. So with that, you typically do your calculations there, and the ability of having a partial note is it kind of unhinges your interest rate from the calculations, and it depends more on the sophistication of the buyer than the sophistication. I guess it depends on both, but you can adjust that. So really, it's just, what is your buyer looking for? And if you're selling to note investors, they're going to want a higher return. That's why I would recommend anybody on this call, if you're looking to get into note investing, start cultivating a group of stable of passive investors. Because a passive investor, you got to remember, their option is put it in the bank. And what are banks paying these days? I mean, it used to be 0.5%. It's probably gone up, but it's certainly not
0.01
keeping
to 0.02 in a savings account.
Really? Still, it's that low. Okay, so there are people who will take 6%, even in today's inflationary economy. People will take 6% and be very happy with it. But note investors are looking for 10 to 15%. So you do the math.
All right. And what happens if the borrower pays off the loan or refinances early?
Do you remember that? Well, whatever the current balance is, okay, that's what they pay. If they pay it off early, because you bought it, if you buy it at a discount, okay, if you buy it at a discount and it's a 20-year loan, you get that discount back every month, a little piece of that discount. You get your principal, you get your interest, and you're getting your discount because you didn't have to pay full price. So you have to wait the full 20 years, okay? If you sell it, if you buy it for a $15,000 discount, and the next month the guy refinances and pays it off, you get that $15,000 right up front. So it's whatever portion, that discount goes to zero as the loan amortizes. So it's whatever portion of that discount is still there when you do the amortization. That's what you get when it refis.
That makes sense. So I'll hold the remainder of my questions. I think Rufus is really wanting to ask some questions.
He's been
here.
patient.
He has been.
All right, Rufus.
Hello. My question is, I've been hearing in the news a lot of implosion. Lenders are going out of business. What do you see as a way to take advantage of that for note buyers right now?
Well, for the last 3 years, it's really been a performing notes market. Okay, there haven't been a lot of non-performing notes on the books. And I think the thing to do is just to get ready for that, I'm not sure I would call it a landslide, but there's certainly going to be an uptick, a significant uptick in the amount of non-performing notes that are available. So the thing to do is just to get into the mix. Just start looking at deals, start analyzing deals. Peggy is a great one for due diligence. She's phenomenal at that. So talk to her maybe about what a due diligence checklist ought to look like. but have your due diligence checklist and start vetting deals on a regular basis. Everybody on this call should be looking at, 20 deals a week, or minimum, right? And if you're not buying, you're honing your ability to figure out what works and what doesn't work. And you should all have a list of criteria that you use to evaluate. For notes, it's going to be one list. For single family homes, it's going to be something else. Depending on what kind of asset you're looking for, you should all have that. And they are starting to move those tapes. Fannie and Freddie are starting to move those, and those are going to start to come down from the big note buyers, because what they do is they buy them in bulk, and then they sell them in smaller blocks, and then eventually people are selling them in onesie twosies. So just get out there and start evaluating it, and give me a call if you're interested. That's it. So I didn't really put that in my contact information. So if I can go into the chat, I should have put that. That should have been the last presentation of my slide. I'm on vacation this week with my grandsons, so I apologize for not being polished. But it's Gary Payrow, and also known as Professor Cashflow. So when I teach, I love teaching, and so when I'm teaching, I'm usually using that moniker. And my number is 818-324-8230, and you can go Gary at passivemonthlyprofits.com.
Have you started selling more partials to kind of free up money to be well funded for the oncoming landslide of?
Yes, and I also buy partials, because you have a lot of flexibility with partials when somebody doesn't have to sell the whole note. If as a sophisticated buyer, you have a lot of advantages. You have a lot more degrees of freedom when purchasing a partial. So
Gary,
I
have
yes,
a question for you.
Yeah.
Can we not agree that the degree of equity in most homes is very, very high still? So the degree of
Yes.
Foreclosures is going to be significantly lower this time around?
Yes, it's not going to be like 2008, absolutely. But there are still people who can't qualify to do a refi. So yes, it's not going to be like it was before. But if you can't refi, what are your options? And so those are the people that are going. There are a lot of baby boomers who don't have the income anymore. And so if they get behind on their note, on their mortgage, what options do they have? They can do a reverse mortgage, but a lot of people are scared of that. And they've heard that that's a ripoff, and so a lot of people are going to be selling, or those notes are going to be going to the market. And actually, that's one of the things that it's not about my main topic, partials, but I really like the idea of using seller financing and buying seller finance notes, or buying non-performing notes to provide housing for people. Because if I come in and buy a non-performing note, the last one I bought was at 50% of the balance, I can now go back in and negotiate new terms for the borrower and hopefully get that note reperforming. So that's something that we didn't talk about, but it's a way that you can save somebody's house. So instead of kicking them out of the house, you can actually go in there and make new terms, lower their payments. It can work for you, and you can still make quite a bit of money, because you don't have as much money in it as the original lender did. You bought it at a discount, so you can lower their payments. You can restructure it. There's some caveats there. I wouldn't just go in and restructure a non-performing loan immediately. You have to use sort of a trial period where you say, well, okay, if you can set up this number of payments, then we'll restructure the note. But it's a great feeling to help people stay in their house rather than kicking them out. Anyone else? Okay, Cliff, did you say you had other questions? I'm sure the crowd, the
I
group would like
do.
to. Oh, go Peggy.
I have something, just a comment you made, because you talked about the quality of the note, the quality of the and the equity. And I know there's a lot of people that have learned how to create notes on their own property and then sell that created note. You did not
Yeah.
talk about that at all. And I don't know if that's appropriate for this, but if you could do the same thing, right? If I own my own rental, I wouldn't do it on my own home, but on a rental home, I could create a note and then I could sell that at whatever discount you wanted. I mean, I've met people that say, we don't care what the interest rate is, we won't buy it without a discount, just not whatever. And so let's just say a 10% return and just sell so you get that cash so you could go do something with the cash.
Okay. Well, I think that seller financing is a great way. Let me just tell you one approach that I really like, and it's given by some folks that are actually Note School students, and they are called creative deal makers. You can find them on Facebook. They do something very clever. It's not new stuff, but it's put together in such a way that it looks new, and it has a great way to roll. You sell a property, you buy a property, and then you sell it with seller financing. And here's the wrinkle: you sell it with two loans. You sell it with a first note and a second note, and then you turn around and sell the first note right off the bat at a discount. But you sell it, and what you can do is you can have enough margin in there so that you can buy the property with hard money, turn it around quickly. Especially what you're trying to do is buy a house that doesn't really need to be rehabbed. It needs to be freshened, like grandma's house. Nobody would really want to live there, but they could. And you sell it to somebody who's not afraid to fix it up, and you sell it quickly. You turn it around in 2 or 3 months, and you have no rehab costs. You get it with hard money, and then you sell it. Then you turn around and sell the first payment, which is the larger one. You sell the first note right at the table, or shortly thereafter, to a note investor who will buy it at a discount, but it's enough to pay off the underlying hard money loan, maybe even have what would be a normal wholesaling fee out of the transaction, and yet you still have this second note in position so that you're making monthly payments. So you do enough of these in a year, and pretty soon, you've got this passive income that just pays all the bills, and yet you still have transactional income, and you still have income that you're building up, so that if somebody pays that off, you get the unpaid balance on that. So you get money now, money every month, and then whenever they sell or refinance, you get money down the road. So that's an example, Peggy, of taking a model where you're taking, sort of under the median type houses, the kinds of houses that would cash flow well in a rental market, and you're converting it into passive income where you have absolutely no management whatsoever, and you're making money like a wholesaler, but you're also building up passive income.
It's really smart. I like that idea. So Cliff, we've got 5 minutes left, and anybody else who has questions?
Yeah, so, and I don't know if you can answer this, Gary, but when you actually sell a parcel, how's that normally taxed? Is that taxed as like a capital gains, and then a state tax on top of that?
Okay, so if you have an asset that you have held for a year, then when you're selling a partial, it's just like selling any asset. Yes, it would be, and I'm not giving tax advice. This is my understanding, and all of this should be checked out with a tax professional. But yes, that would be considered capital gains, taxes, and the new owner would then be getting regular income because that would now be interest income. So in some cases, that might be a benefit to you because if you've got a lot of income tax in that bucket, converting some of it to capital gains might be a benefit.
And maybe picking up some non-performing notes may help offset that.
Maybe.
That's possible.
Okay.
I also know a
If I
guy.
may,
Sally.
Yes, Sally.
I'm actually working with a client right now where his CPA in his LLC has his notes as interest income, getting charged higher than capital gains, and that's why he's looking at to transfer it into a spendthrift trust. I don't know if the accountant's doing it correctly or incorrectly. I just know on his taxes, that's how it was done.
I think that sounds reasonable. Interest income is interest income. If you're holding the note and charging interest, that's why a lot of people like to put their notes into IRAs. And
Correct.
the other nice thing is you can sell the whole strategy of selling a partial is really great in an IRA because you can basically take the note, buy it, sell a partial, get almost all your money back, and yet you've got this residual income, which is great for a retirement account because it comes in down the road when you're going to be needing it, and then you get most of your money back, so you can go in and just continue to buy assets without depleting your IRA. So I think that selling partials is a great strategy for IRA holders.
Thank you, Gary. Seema,
Thank you.
you have a question?
There's a guy I know, as does Peggy, who sells these notes and says that you can then take it against your income taxes. And my accountant has refused to do it. He will take $20,000 for $500,000 note and then tries to sell it for high income people. I have a call coming. I have to go, but I will not go, but I'll make it.
I'm not sure what she was trying to say there. Did anybody decipher that?
The person that's selling that is saying that you can have this loss all these years because the note is, I don't really remember. It's been so long since I've heard what he says, but he's saying that you can write it off as a loss because you're only paying a smaller amount for a larger note. Yeah.
No, I do know
Talk
that,
to Andy. Andy, it's Andy.
yeah, okay. That's yeah, I'm familiar with Andy, and that's an interesting thought.
And it is, and I haven't figured out how that works, and Seema's taken it to her CPA, and our CPA doesn't think it will work.
Yeah.
So they haven't gotten.
It's a very creative tax strategy, and as creative tax strategies go, they run afoul of most accountants because most accountants don't like to be super creative. So
Yeah, let me
they like
weigh
to
in about
research.
that if I can. This is a very, very important point. If you want aggressive tax strategy, you need an LLM in tax. That's where you go for aggressive tax strategy. And they'll tell you if it's going to get you in jail or if you're just breaking pushing the curve, if you will. So my good friend Lauren Cadillac, as Dan knows, might be a good person to talk to about those kind of strategies. But accountants, they will not touch like the out of the box stuff with a 10-foot pole generally.
What's an LOM, Douglas?
It's Masters in Tax. It's tax law. It's there is a JD, which is all lawyers get, and then there's an LLM tax where they specialize. And the funny thing is a good portion of them have CPAs, but then they go on to law school and then get a tax master's in tax law is what it is.
Yeah, and if you're on LinkedIn, I saw that she posted her degree today, so you can print it out and you'll have one too.
Yeah.
Oh, how fun.
White it out and put my name in there. That's not a bad
Get
idea.
out your crayons.
That sounds like fun.
Right. Green ones.
Oh, I miss her. Any other questions for Gary? Okay.
Nika,
Well,
were you
thank you
wanting
for coming.
clarification on one of your, no, you're good? Okay.
Hey, Gary, I just asked in the chat, the Facebook group, you kind of mentioned it in passing, but is that Creative Deal Maker?
I'm going to click on your link that you posted, and I'm going to tell. It looks like, yes, those are the guys.
Okay, awesome. Thanks.
Sure.
What are the guys?
Nick and Nick and he's got like a Greek sounding, and Nick Legaramo and then Sean.
Yeah, they're
Is
note
it Sean?
buyers. We've had a
They're
few
note buyers.
few of them on before previously.
Yeah.
We'll have them on again because it's always an interesting subject and things keep changing. So
And if we have any note buyers on the line, I actually have, I'm doing some consulting with a company called Note Unlimited on their note management software. And it's called Note Unlimited, and you can get a 10% discount on their lifetime 10% discount if you want to reach out to me. And as a matter of fact, I can even put the code in the chat.
okay, why don't you
Looks
do
like
that
Frank might
while
have a
Frank
question, too.
asks you one more question?
Sure.
A quick question here at a high level. I'm familiar with notes, but I've never gone and bought and sold on a marketplace. And I was just looking at one of the marketplaces. It looks deceptively easy. Is there a course of training, or what's the best way to go about this if I wanted to kind of go the next level of information and learning?
Well, Note School TV is a great source of information. That's Note School TV on Facebook. There's note buying podcasts. There's a good thing to do would be to just connect with me, and I can point you in good directions. You can also, ask, well, if you wanted to actually invest in a note, I could help you do that. Let's see. But that's there's a lot of individual places where you can go. There's so much knowledge out there on the internet right now that's for free. But Note School TV and some of the note buying podcasts that are out there are excellent sources. And it is very easy to spend your money.
That's what it looks like. That's exactly what it looks like.
Yeah, but that's generally the case. I mean, people are always willing to take your money. So, let the buyer beware. But was that Frank who was talking?
Yes.
Okay, Frank. Yeah. Reach out to me and we can chat, and I can give you some pointers. And I'd love to, walk you through a couple of deals. And I have people who ask me for help. I have Note School students who call me and are trying to. It's a struggle sometimes to get the ball rolling, but the nice thing about notes is you can scale your risk relative and the size. You don't have to invest $100,000. You can generally find small, and that's the other nice thing about partials is you can buy a smaller chunk and not put up quite so much money. So that's I should have put that on the chart, but. Just give me a call, Frank, if you want, and we can.
Thank you.
Chat.
Thank you, Frank, for that last question. And thank you very much, Gary, for coming on the show. We really appreciate it. We like
It was my pleasure.
all the different ways that there are to. So thank you very much.
All right. Thank you all. Look forward to talking to you more.